bottoming is typically a process. We were buying into the downdraft. We think October 28th was probably the bottom in terms of the quarter. And we think we're likely to bounce from here and end the year stronger. I think the bottom line is the economic reality is not as bad as the stock market performance we've seen this year. So we're barely up on the S&P 500. We've got major international markets down pretty substantively. But meanwhile, the big story of 2018 is that we're going to have 25% earnings growth. And we've seen a big improvement in valuation here.
I hear what you're saying, but you don't seem to be saying it with quite as much conviction. Are you buying into this dip too, or are you kind of just holding and wait to see what happens?
So, we bought on the first dip. We're comfortable with our positioning now. We're overweight U.S. equities. We're still modestly underweight international equities. We have the biggest near-term conviction in the U.S. market, given the very positive near-term fundamentals.
Phil, how about you?
We're similarly positioned to what Ed talked about, in that we are also overweight equities. But I think, yes, things are turning. Everybody talks about late cycle, but I think the earnings that we heard from Home Depot this morning, and we probably hear similar ones from Lowe's, because they really are bellwethers rather than individual companies when it comes out to their sales. And I think what you're seeing right now is that their sales are very good because higher wages and the good economy is still outweighing the effect of rising interest rates. But at some point, rising interest rates and our 30-year mortgages at JP Morgan are knocking on the door of 5%.
Right.
And we haven't been there in a long time. And so that's like a bit of a titanic struggle right now. And as interest rates keep going up, will it start having effect on earnings, like some of the stellar companies that we heard this morning?
So you're sounding just as sort of hesitant to kind of jump in. You're thinking that we're not at the end of a bull market, but you don't sound like you're ready to completely pile in.
No, we're not. And so what we're doing, instead of actually reducing the amount of equities in our portfolio, we've taken steps on our fixed income side where we're reducing the amount of credit, increasing the duration of our risk-free or core-free bonds, and then even within equities, adding some sectors like utilities, which I give you, are really more bond-like to prepare us as we're going forward. So what that does is it allows us to still keep an overweight in equities, but the overall risk of those equities is less than it might have been 6 months ago.
Ed, are you doing the same thing? And I ask because technology stocks were hit so hard yesterday. People kind of running from those growth names, looking more for high quality or for value stocks.
No, I mean, we still like tech. We're overweight tech. I think it's premature to think that leadership is going to shift away from tech. Leadership does not typically shift in the late cycle. And when we look at technology, it still has by far the best fundamentals in terms of relative earnings growth. The valuations, yes, it's trading at a premium to the S&P, but it's a small premium, and I think it deserves a premium. The regulatory risk is there, but I think that's overplayed in the short run. I think that's something that's likely to be slow moving, given the complexities involved and the lack of consensus about how to move forward. So I think the near-term fundamentals are still going to drive tech as an outperformer, at least between now and year end. I think we're still going to have rough sledding in terms of volatility and overall returns until we get a signal from the Fed that they're ready to back off.